everyone. My name is Corey Daharsh, and I'm with Advanta IRA. We're here with today's educational webinar on how a general partner prospects syndication deals. Again, I'm Corey Daharsh, and my guest speaker today is Tyler Burks. He is the Managing Director of Development over at PETRA. Tyler, thank you very much for joining us on today's webinar. I greatly appreciate your time and energy, and I think we're going to bring some great content to the audience. Thank you very much for joining me.
Thanks for having me, Corey. I appreciate it.
Awesome. So just for the audience sake, I'm going to go over a brief agenda on what we're going to cover today, starting with who Advanta IRA is and what is a self-directed retirement account. Then why do investors choose to start self-directing? What's the timeline, process, and general cost to get one of these accounts started? How do you invest your retirement dollars into a syndication deal? And once I cover that portion from the self-directed side of things, I'm going to turn the presentation over to Tyler, who's going to cover how a general partner or general partnership team identifies and targets specific prospects. So we'll cover all of that, and then we have some questions and a conclusion at the end. We will be going through some questions throughout the presentation just to make sure we're clearing everything for the audience. So without further ado, I'm just going to bring up some basic information about Advanta IRA. We are a self-directed IRA administrator, and we've been in the industry for over 20 years now. Our client base has just under $3 billion in assets under management, and we do expect to cross that threshold by the end of this calendar year. We have all of our clients' funds that are not actively invested, sitting in insured accounts in basic trust bank accounts until the client decides where and when to place the money. And each client of ours has a dedicated client account manager, a one-to-one contact. So they're not reaching out to a call center or a huge corporation where they have to explain who they are and what they're trying to do each time they want to make a transaction with their self-directed account, or even have questions about the IRS's rules and regulations. We try our best to provide great education by way of these types of webinars, and also a white glove customer service to our clients when they have active accounts with us. Just a brief disclaimer before we get too far into today's webinar. Myself and Advanta IRA are here to provide educational content. We do not provide any investment advice or endorse any specific products or offerings or opportunities or strategies. It's always up to the self-directed investor to do their own due diligence, whether that means looking through things yourself with a fine-tooth comb or building your own team of attorneys, CPAs, advisors to make sure you've thoroughly reviewed any investment you decide to partake in. If you do need some assistance finding the right attorney, accountant that is familiar with self-directed investing, you can reach out and let me know. We have both clients of ours that do those various services and non-clients of ours that are referral partners that are very familiar with the alternative investing space, as well as their own expertise, whether it be legal, financial, tax. Let me know if you're looking for someone that has specific expertise in alternative investing. If you've never heard about self-directed retirement accounts, it's actually very common. Only about 4% of US retirement accounts are being self-directed. And we're talking about your IRAs, your 401ks, any US-based retirement account. That industry in itself has about $40 trillion in it. So there's about $40 trillion of tax benefit retirement accounts, and only 4% or roughly 1.5 trillion are actively being self-directed. And you may ask yourself, why is that? Why are more people not taking advantage of these great strategies and these great opportunities? And it's mostly because people just don't know that it even exists. We have a real strong presence in the education and expanding knowledge about this side of things. But on the flip side of that, your financial advisors or fiduciary custodians have a vested interest in not letting you know that this exists, because that keeps your money in their hands, where they're charging you some sort of rate or percentage on the earnings that they invest your money on your behalf for you. And sometimes they even try to use tactics to make you think it's too scary or too vulnerable to self-direct. But as long as you're doing the due diligence thoroughly, as I referenced earlier, why wouldn't you want your tax sheltered money in your own hands going into investments that you've hand selected? I briefly touched on the types of plans that can be invested into a self-direct account, but I just want to illustrate that a little bit further here. Most people are very familiar with your standard traditional and Roth IRAs. Pretty much anyone can have a Roth or a traditional IRA. You can add money into it annually based on your ordinary earned income. But if you're a small business owner or self-employed, they also have SEP and simple IRAs and solo 401k plans with a bit higher annual contribution limit than a traditional or a Roth IRA. Those are plans for small business or self-employed individuals. And then we also have health savings and education savings accounts that can be self-directed. So if you're someone with a high deductible health policy, you can have an HSA account that you can self-direct into alternatives, and also an education savings account or a Coverdell education savings account that you can put about $2,000 aside each year for those young ones in your life. You can invest that money, grow, earn on it, while also pulling money in a tax benefiting capacity anytime they have educational expenses that come up. If you're interested in any specific nuances of the plan types or just want to talk through what plan type fits your need best, feel free to reach out and let me know. So why are IRAs and 401ks a good source of capital? Well, first off, it's real easy to reinvest. So if you're joining a syndication deal like we're here to talk about today, and that deal goes full cycle within roughly 5 years, 7 years, it's a general time frame for this type of investment, it's very easy to redeploy that capital either with that same syndication group or with another syndication group. It's very easy to do so. A lot of people are not expecting to use this money for a long time because maybe you're in your 30s or 40s and don't plan to retire until your 60s or 70s. That's a lot of capital that you have sitting that you could put in a fluctuating stock market, or you could put into a more stable asset class, whatever that may be. Again, we're talking about syndications here today, so long-term real estate plays where you're a limited partner and a general partnership team's actually doing all the day-to-day work on behalf of the transaction and on behalf of the deal. These investments often have a much higher return than some of the alternatives like a money market or a savings account or a CD. So that's a lot of the reason people just pull money out of their savings and push it into these types of assets or their self-directed account. It just can typically yield a much higher return than some of the alternatives and a lot less fluctuation or variability. And there's no outside approval when you're self-directing. Again, self-direction is the name. You are the person making the final decision. There's no one over your head saying, oh, this is a good idea, this is a bad idea. I won't let you make this investment because it doesn't follow our protocols or our rules. Advanta IRA is here just to keep you within the IRS rules and regulations and help you understand those rules and strategize and structure your investments within those rules. We're not here to tell you what you can or cannot do. We're just here to share with you the IRS rules and let you figure out your investments from there. Having said that, it is very important to invest with people you know. It's always important to, in any walk of life, build that triad of know, like, trust. So network in your local community. A lot of people find great value in their local RIA group, Real Estate Investor Association. You can go online and find a meetup group or a group on Facebook or any of those social media platforms that are usually like-minded investors that you can get to know. That helps you in many capacities. You can get to know people that are great to work with, and you can also get word of mouth and find people you may want to shy away from working with. But always, again, I can't beat home enough, do your due diligence, get comfortable with the people you plan to transact with and deal with. So how to invest into multifamily? There are a few different ways to do so. We're here to talk about syndications primarily, but I just want to outline a few other options and opportunities. So syndication, I just went over it on a few slides ago. Your retirement account effectively invests as a limited partner into a deal where a general partnership team, which Tyler is going to represent later in the presentation, does the due diligence, does the underwriting, does the overhead of finding the deal, making sure it's structured and set up to be successful, and then carrying through on that action plan. But other options you can do to invest into multifamily would be private lending, basically using your retirement account to be a mortgage lender. You set the terms, you agree on whatever security instrument you can claim if the terms are not met or the payments are defaulted, and basically you hold that loan through your retirement account And one other option is doing a joint venture agreement where you maybe have capital in your retirement account to bring to the table, and someone you want to deal with and partner with has a piece of property or a piece of raw land that needs to be developed. You can set up an investment structure where you're bringing the cash, the other person's bringing whatever assets or potential cash as well into the deal, and then you have a set action plan as to how the profits and proceeds of that deal are going to be split at the ending of the transaction. Just to put that into perspective, these are all great options, but it's up to you to do your due diligence and decide which option fits best with your needs, with your level of involvement preferred, and various factors that may include, how much money you have available to invest, what your risk factor is. So hopefully everyone has a good understanding of that. I'm going to turn now just to a simple case study, and then we'll get Tyler the microphone so he can go ahead and do his portion of the presentation. But again, this is just a simple case study with very rounded numbers on how to make a syndication investment with a retirement account. So I've got a gentleman named Abel, and he meets another gentleman named John. John has an investment opportunity in a syndication. They talk over the deal. John provides Abel what's typically referred to as a PPM, a private placement memorandum, or a prospectus, so that he can look over all of the details about this deal. That's doing his due diligence. Maybe he consults with his attorney, maybe he consults with the CPA, but effectively, Abel decides, yes, I want to participate in this investment. I'm going to do $50,000 into this deal. He has that in a managed IRA with another company. So he goes ahead and gets the Advanta application paperwork done. In that, he'll submit a transfer request form so we can move the funds from his existing retirement account over to Advanta. And while we're waiting on those funds to come in, we'll typically collect the subscription paperwork from John, get Abel to approve that ahead of time so that we can get this investment funded basically as soon as the money hits the new Advanta IRA account. Again, the process is that we're getting Abel to approve the paperwork, but we're executing it and facilitating the investment on behalf of the retirement account. So the investor listed on all this paperwork is going to be the retirement account in itself, not Abel's social security number. It's very important that the accurate name of the retirement account is listed and the tax ID number for the retirement account so that Abel does not have any potential tax consequences or issues later on. That's our job, to make sure this is as smooth and simple as possible. Once the client authorizes the transaction, we go ahead and execute it and send the funds over to John and his team. And then from there, a typical structure for payout in this type of situation is that a preferred distribution is sent to all subscribers. 8% is a rounded but reasonable number. So 8% generated on the $50,000 investment. And then after year 5, the project is refinanced and Abel receives a lump sum of $65,000 as a payout. So in total, for 5 years of a $50,000 investment, there's been $35,000 of profit generated. That's $4,000 a year in total, $20,000 in preferred annual distributions, plus the extra $15,000 lump sum in the final payout and return of the initial capital that was invested into the deal. This may not be the exact case scenario for every investment, but it is reasonable and it is something just to set the basis of what you're looking at when you do this type of transaction. Real quickly, Advanta IRA does do a lot of educational content. We do 2 of these educational webinars a week. You can find all of the previous recordings on our YouTube page. We have a blog if you're looking at industry standard news or specific news coming up. We're in an election year right now, so there may be some legislation that affects self-directed investing. You could check all of that out on our website or on our YouTube channel. We also have a podcast called the Alternative Investing Advantage Podcast. You can check that out anywhere you get your podcasts. My colleague Alex Perney hosts it, and he brings on great expert guests to speak about their avenues of investing in different strategies. We have a networking event every final Friday of the month called Pitch, Promote, and Prosper. That's a session where you basically get an elevator pitch on a Zoom call to say who you are and what you're looking to invest into or what you have to offer for investors. And it's a collective of like-minded individuals looking to network together and with each other in a real collaborative capacity. So check that out. That is the final Friday of every month from 12 to 1 p.m. roughly Eastern time. It's really easy to get one of these accounts set up. The application really just takes you about 15 minutes or so. We get the account opened and funded within roughly a week to a week and a half in most cases, and then you're able to start investing however you want to. If you're interested in that, please feel free to reach out and let me know. I'd be happy to speak through what plan type fits best for you or what you need to get this done. And without further ado, I'm going to turn it over to Tyler to cover how a general partner identifies and targets specific projects. Tyler, the floor is yours.
Thanks, Corey. I appreciate your initial presentation there. I will say that you did a great job on painting the picture for what a syndication looks like in a real estate project. So thank you very much for painting that picture for us. It's very similar to what we'll be going over here today. And the idea of this presentation is to give you guys an idea of what we're looking at as a general partner, starting from the very top of analyzing a deal and then considering all of the different facets of what we have to do as a general partner and understand all the makeup of those different actions and how we put all that together, and which is what determines what type of project we're going to shoot for. So that's without further ado on that one. So essentially it's just giving you guys the nitty-gritty details of a general partner and what we're taking into consideration for our own investors and also our real estate firm, because everything that we're looking at investing ourselves. So we're investing alongside any of our LPs, LPs being limited partners, which would in this case be you guys potentially. And then so you can get an understanding of what it is that we're truly looking at. And essentially, I just have a quick little quote in here: victory comes from finding opportunities and problems. So essentially, us as general partners and developers or syndicators, we are problem solvers, right? We're finding the best problems to solve that allow us and our investors to, have the greatest return. And then just a little bit about us at Petra. We're more than just a real estate company. So we're vertically integrated. We have all kinds of different facets of the company that allow us to work alongside multiple clients and partners. And so that includes investment, real estate brokerage, mortgage brokerage, real estate development, and property management, asset management, which isn't included in here, and a holistic of other things that come along with what we can offer as Petra. And then also we have a consulting piece inside of our company as well. There's plenty of times where there's property owners, they have this great idea, they want to be a developer, or they want to reposition a property, but they don't have all the means or the resources or even the knowledge necessary. So then they bring us on as a development or redevelopment consultant, and we help guide them through that process, right? And then essentially another quote in here, alone we can do so little, together we can do so much. We love partnerships and we love working with other folks to help them get their real estate project out of the ground. And then that leads us into, in order to really narrow down what it is that we're going to be building or targeting, we have to understand the different types of real estate. And then find the specific niche that we're going to be in. So number one, residential. Many developers are inside of this, us included, which can consist of single family, and single family essentially falls in the category of 1 to 4 unit buildings. And then you go to build to rent, which also falls in line with that, 1 to 4 units, with some caveats to that. And then multifamily, which falls also into commercial as well, but that's essentially 5 or more units in one building. And then a mixed use residential with some commercial. So typically that's all on the same parcel where the development is happening all around the same time. And a lot of times what that ends up being is a little bit more of your downtown or your city centers type of projects where there's ground floor retail and then residential units above that. And then we go into commercial. Commercial kind of bleeds into the industrial as well, but can consist of multifamily. We already mentioned that before. Retail, office, again, mixed use, which mixed use can be essentially what it sounds like, mixed use of office, and then you have retail, things like that. So that therefore wouldn't fall under residential, but falls under commercial. Hospitality, which is our hotels, Airbnb, things like that. Storage and entertainment. And then industrial, which also is a component of commercial, but it's kind of in its own category because it has also a vast array of different types of industrial. So that is flex space, right? So it's just a big box that's essentially created by the developer to allow different types of businesses to conduct their business inside of. Manufacturing warehouse, data centers, cold storage, and distribution warehouses, etc. And then from there, we have our 3 key factors for identifying a property, right? So it's going to be your location is the #1 rule, right? So anytime you get into real estate school, you're going to see the adage that says location, 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 right? That's the most important thing in real estate. You want to consider of where it's at, right? And where it's at tells you what you can build, how big you can build it, how much it's going to cost, things like that. So location is a #1 key factor. And then why are we doing this? Why are we building this property, right? And then that leads into the who, what, and when, which is who is going to be the end user, and what is the project going, and when is the project going to be built. And then now that kind of goes into what it is that we're doing as a general partner. General partner is typically one or more investor who jointly own a business, i.e. a real estate firm like Petra, and then it's structured in a partnership entity, and we assume the day-to-day responsibilities of the project or projects. And then a GP typically brings in specialized knowledge and expertise to the partnership. So each partner inside of the general partnership has their own expertise and their own lane, essentially, that they kind of hang out in, and what their task of the day-to-day operations are. And then a GP can range anywhere between some individual investor, which is typically kind of your fix and flip person, running it on an individual basis, or a boutique firm, which is Petra. We have about 30 people in the company. And then a large REIT, which would be like your Blackstones of the world or your KKR, things like that, publicly traded company. And then what we do, essentially, we find the project or property. Market research is very big, networking and marketing. So we have a whole network and marketing resource of the company, and then source quality projects and properties to invest in. Project analysis, once we find a project that we're going to be targeting, we have to go into an analysis, right? Underwriting the pro forma, gathering further research information, background on the property or the project. And then the pro forma is essentially your cash inflows and outflows projections, and then it basically gives you a go or no-go analysis on the property. And then from there, we make our offer, contract the property, and raise capital. So a lot of these happen simultaneously once we get under contract. So then we're going to, once we get it under contract and our offer is made, we get it under contract, we create what Corey mentioned earlier, which is a private placement memorandum, or PPM, or also an offering memorandum, an OM, as we otherwise would say. And it's basically a whole pitch deck on the project and property itself, the potential returns, the potential timeline, all the different facets of the project, so you can get a good idea of it. And then lastly there, we have construction management. Once we've gotten through the entitlements of the project, and then also permitting, raise the capital, all the things, then we're going into construction management. We're going to break ground, and then this could happen anywhere between a 3 to 24 to 36 month process, depending on the scope of the project. And then we'll manage that as it goes through. And then kind of diving deeper into the why solution of why it is that we're building what we're building. And then essentially it starts out with the business idea, right? So we all have some sort of business idea that allows us to grow as a company, and then also others to participate in the benefits of what we're putting together. And then general partners have a knack for action, right? So we're entrepreneurs at heart. We only eat what we kill, essentially. So we have to have a knack for action and put things together constantly. So we're always looking at deals and trying to put them together. And then this is, for everyone's benefit, right? So we're doing a lot of this upfront work, this idea, putting together ideas and putting everything in place so everybody else can benefit from that. And then ultimately, a wealth generation factor comes from real estate. And it's a great vehicle for building generational wealth, create firms that allow for themselves to participate in the wealth building effects of real estate. Cash flow is a big one that you see there. There's also some tax benefits as well. Consult your CPA on that one. And then, of course, the team atmosphere. You can't do this alone. This is why we love partnerships so much. Just being around a team and solving the problems, as I mentioned earlier, is why we do what we do. We just enjoy it. And then, of course, accomplishing goals, right? So we're setting out with our team and adhering to all of our different personality traits and everything like that to accomplish a big goal that everybody gets the benefit from. And then the where, right? So I mentioned this earlier, location, 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 and all the different facets that happen. And this is by no means comprehensive in what we're doing in order to find a property. There's many things beyond what you see here, what we're doing, but just kind of in a nutshell, we start with our market research, right? We're doing demographic studies, figuring out the area income, what's the job growth, what's the population growth, how are the rental rates, what's the supply and demand, right? Simple business metrics there, and then comparing it to other markets, which allows us to target in on a particular market. The market that I'm in primarily is in Kansas City. There's other markets that we're in as well, but we're always doing some sort of comparing and contrasting to other markets. And then ultimately, we're going into networking from there, right? So we're building a contact list, attending webinars such as this, also seminars and panels and events and things like that. Social media, cold calling, we still do that. Introductions from others, which is always great. And then visiting new places, right? So we're always traveling around and seeing the next best thing. And then, of course, that leads into site visits. We are checking out the physical property itself, getting a feel, getting a flow for what the property itself is providing us and what we could truly do to it. Viewing the surrounding areas is very important. Is there other projects going on? Are there other developers in the area? What other, investment firms are in the area? What's going on, right? And then we meet with the locals, and they can kind of give us a pretty good insight, just from living there on what's going on as well. And then, of course, envisioning the project, right? So we have to be really, really big imaginators, if you will, and big thinkers and all of that from a general partner perspective. Yeah. And so, we essentially have to look at a blank piece of ground or a dilapidated property and see it beyond what its current state is and see the end vision. So we definitely have to envision the project coming to life. And then, of course, meeting with city officials, it's always great to meet them in person. And then they can tell us, what it is that they're looking for in a particular project at a particular site. And then from there, once we've gathered all that information, we've felt the property, in its physical form, then we start running pro formas, coming up with a concept plan with the architects and engineers, retrieving third-party reports. That could be anywhere between traffic study to a geotechnical report, soil report, EPA report, things like that. And then, of course, retrieving contractor bids. This is probably everybody's least favorite part of it all because, this can definitely make or break a project. The construction side of things is a huge component of it, probably one of the more important sides of everything. And if the design from the architects isn't right, then it can run up the contractor bid, so quite a bit. Hiring property managers, defining the exit strategy, and then stress testing that strategy, just always protecting the downside. So what's the worst case scenario? We're always trying to plan for that. And then lastly, putting it all into action, right? So we gathered all of the information, we put together the team, we defined the strategy, and then now it's time to hit the go button. Who, what, and when. So this is basically all the players that are going to be at play here, and then also who the project's being built for, right? So this also bleeds into the project design as well. So if we understand who the end user is and who's going to be used the space, that will determine our design direction. And then what it is, right? So then once we kind of figure out the who of the project, then what is it that we're going to be building, right? Is it a multifamily? Is it a multifamily that has some sort of retail component in it? Is it a community that has townhomes over here, apartments commercial, office, etc. Right? So what is it that we're doing here? And then when is this going to take place, right? So then we have to consider the timelines and getting the approvals through the city, and also when we can raise the capital and get the funding for the project in place as well. All plays a huge factor in when this is going to happen. Capital formation, we just mentioned that as well. Basically, who is going to be the investors or the investment group? Hopefully some folks on here on this call would understand or would want to participate in one of these projects here in the future. And then how much will the LPs invest? And then also when can we form that capital stack? And then lining it all up, right? So all of this is happening simultaneous to one another. I mean, there's not one thing that takes priority over the other. They are all working together, and they are all just as important as the next thing. All right, and then from there, once we start gathering up a lot of those other things too, we're having to create a concept plan, right? So we have to make sure that the site that has been presented to us by our networking, or if we're doing our own research and we say, hey, we really want to do this site, put a project here in this site, but we don't fully know what we can do yet. So we have to go to our architects and get some sort of a concept plan, so then we can start understanding, what can we truly build there, and then that leads into the unit mix and the unit count based upon the location. And then so this will have a huge driving factor on how the project is stabilized and how the financials will work, right? So if we have a unit mix that's heavy on studios, the numbers won't be, the return dollars won't be as high. But if we have something that is only geared towards 2 and 3 bedroom homes, then we're hitting a certain demographic in a particular area that may not fit for that, right? So then we have to take into all of those things into consideration whenever we're coming up with a concept plan. And of course, the project phases are just as important as well. This goes back into the when and where, obviously, of the project. So phase 1 comes in based upon how we determine the absorption of the units are going to happen. And that comes through our demographic and our market study. And then also when the funding is going to be coming in place, right? So banks can't write, a blank check for one big project to go run it at once. It's a strategic play on when we're going to be pulling those dollars out of the bank and putting them in play on the construction itself. And it's, coming up with a strategic plan on when those dollars are going to be allocated to certain parts of the project, and then moving on to the next phase. And then, so once we get that going, the phases, everything else going on, we're sending our concept plans and our drawings out to construction and general contractor for bids. This is so we can get a scope of work. And then what you see here on this page is a sample scope of work for a particular project in the Midwest region. And then this is something that we're really looking at from a market to market standpoint, and then also a unit mix or unit type, those kinds of things. As you can see, the cottage homes are a little bit more expensive per unit than duplexes or apartments, which makes a huge difference in what it is that we're shooting for, right? Again, this goes back to location, the who, the what, the where, all these different things playing a huge factor in how our scope of work is going to be put together. And then I mentioned this earlier, cost per unit, right? So this allows us to compare and contrast markets as well. So not only demographics and rental and absorption and supply and demand, but also construction costs, right? So all of those things play a huge factor in how we're going to approach a particular project in a particular area. And that cost per unit can sway hugely the direction in which we go, right? So we come up with a concept plan, it sounds great. We really like this idea, but then, okay, the reality sets in of the construction bid and say, oh, we can't really do that here in this moment because the rents aren't high enough. But if we dial this back a little bit and kind of reconfigure our plan, we can do this based upon this scope of work. And then again, pro forma pops up again. We talked about this numerous times. So whenever we're going through a project, we probably underwrite a project at least 3 to 5 times. So we have our initial pro forma, right? So just I find a site, let's say it's 10 acres or so, and I know the types of metrics that I need to hit for my investors, and that's typically yield on cost and then the limited partner internal rate of return. So those are the two main things that I'm looking at. And if I can hit those on my initial pro forma, that gives me an idea that, hey, all the other metrics typically fall in line if I can hit those two. And then it allows me to start going down the line, right? So I have my initial pro forma. Okay, this is where I think I need to be for this particular site, and then I send it over to my design team and give them the game plan, saying, hey, for this particular site, we need to hit this, around this amount of units and around this size of project. And then they come up with a concept plan, go back to the drawing board with the pro forma, make adjustments, and then go to contractor bid, get the bids back, re-pro forma the property again, talk with the equity investors. They tell us what they're looking for. Okay, go back to the pro forma, come up with a plan, and then it's a constant levers and dials there. So the two main things that we're looking for, firstly, yield on cost, and you can see that in here under development returns, that first line there. The big thing that we're looking for is untrended, right? So today's cost versus what our future net operating income is going to be. And typically we want to be around a 7% for that. 7% or higher is great. And then our limited partner return, internal rate of return. So this is basically time value of money. So dollars going in versus dollars coming out, and the amount of time spent in that investment. Spit you out a number. Typically we try to shoot for high teens and low 20s. My goal in my pro forma is to get around that 20% range before I start pushing things forward.
And Tyler, we did have a question from the audience on that 20% kind of rough figure on the IRR. Is that typical for a large project? Is roughly around that 20 number?
Yeah, around there is a typical target, especially in today's market, right? So we want higher yielding returns on a somewhat higher risk. Construction is higher risk in comparison to buying an existing asset, right? So we have to target a little bit higher of a return as far as the IRR goes. But so that is a typical target. But usually if we hit the yield on cost at 7%, basically our build to cap rate, we're typically going to be hitting that IRR, and then also that IRR tells us how we're going to play out the time frame that we're shooting for this project, right? So the faster the project happens, the higher the IRR. The slower the project happens, the lower the IRR. But then there's other, positives and negatives that come with that. Okay, then once we've underwritten this thing about 5 times and we feel pretty good about where we're at, and we've gathered a lot of information to feel good about going to the city, we go for a zoning approval, right? So not every piece of property is zoned for the use case that we're trying to shoot for, but it may fit the city's comprehensive plan. So if we go to the city and chat with them and say, hey, I've got this 4 acres here in this infill city center location of a suburb of Kansas City, but this zone it's currently a car wash now and a storage unit, but they've been there since the 70s and they're run down. How do you feel about us putting in a really nice mixed use apartment with ground floor retail? And they say, actually, that was inside of our comprehensive plan. This works really well, but we still need to go through a zoning and approval process. And then typically that can happen anywhere between 3 to 12 months, depending on your municipality. Kansas City proper itself, it might take 24 months. Places out in California or New York might take even longer. But then the suburbs of Kansas City, they're typically 90 days. They're very friendly to developers. They actually help and aid us in the process as well. So those are typically the target municipalities that we go for to get zoning approvals. And then once we get zoning approval, some municipalities will allow you to do plat approval all at the same time. With the zoning approval, other municipalities say, hey, we need to get zoning approval first, then we can do plat approval. So this also plays into a factor of the types of projects that we're going to be targeting and where we're going to target them. Is the municipality friendly and efficient? in their process? Are they going to make us go do extra work for something that we can do on an efficient manner? So we definitely target municipalities that have this process in a simultaneous way. So plat approval is basically taking that, what you would see on a 2D sketch of an engineering sketch or an architecture sketch, and then you can see, the different parcels of ground, portioned out to where they would be, and then basically that is the city's approval process as well, right? So the zoning allows for, to us to hit certain zoning metrics and setback requirements and things like that, and then the plat basically says, okay, this is how we're fitting inside of that zone, essentially, and then the city will ultimately sign off on that.
And just another question from the audience, kind of as it relates here. You mentioned Kansas City and being inside Kansas City proper. The audience is just asking what other markets you at Petra might look for deals in, and then also, do you look at vacant land? So I mean, we're talking in city and city proper. There's probably not much vacant land to develop, but is that an area of interest for Petra as well?
Great question for both of them. So the first one is, yes, we do look at other markets. We're mostly in the Midwest, but also into the South as well. In Southeast, we're actually looking at projects in the Southeast, but we really love Kansas City, love Northwest Arkansas, that Bentonville, Fayetteville area. What's happening in that area is just absolutely amazing. So we're looking at projects there. In Dallas-Fort Worth, that's a constant large market that just a lot of investors like to go to. It hits all the metrics. And then so that leads into the types of ground that we're looking for. So we're not always looking at infill types of locations. We're looking at greenfield. So yes, vacant ground. I actually have a project right now that I'm working on that's going to be a larger master plan. It's over 100 acres. So yes, so we do multiple different types of site selection locations and things like that as far as current use cases.
All right, wonderful. Thank you. I'll go ahead and push to the next slide.
All right. All right, this is the fun part here, is the construction phase, right? So again, this goes back into our consideration for the projects that we're looking at, and are we going to pull the trigger on these and things like that. The construction phase, so how are we going to phase out this construction? Does it fit inside of the project plan? And then so two things is the horizontal phase, which is essentially kind of what you see here. This is kind of in a blended phase right now. It looks like the horizontals are pretty close to being done, if not mostly done. And then you see a little bit of the vertical walls coming up on this one. So this is kind of a blended of what you see here, horizontal and vertical. So once the permits have been pulled, we get a ground disturbance permit, and we can start getting the big bulldozers out there, leveling things out, putting in the infrastructure, utilities, the sewer, water, cable, etc. And then we're going vertical from there. This is where we get to see the project come to life. This is probably one of my most favorite pieces of the development. All this upfront work and studying and information gathering that we've done the entire time leading up to, and we've talked to numerous investors and sold them on the idea to believe in us, that kind of thing. And then now it's here, and the physical form is taking shape, which is my favorite part of it. And then also considering that too, there's new forms of construction that we're even looking at for some of our other projects, is modular, right? So while the horizontal phase is going on, the physical vertical form of the building is being built on an offsite location in a climate controlled warehouse. And then once the horizontal phase is done, just like as you see here, there's a crane. There would be a crane just setting these boxes on top of one another, essentially in a really cool way. Looks like a big gigantic Lego set or connector set, but this is kind of a new phase of style of construction that's going on right now, and something that's also very exciting to see. So yeah, so this is by far and away my favorite part of the whole development side of things. And lastly, we have completion and stabilization. This is where the project is actually living and breathing. There's people moving in and out of it. There's leases that are put in place, cash flow starting to come in. So we have the certificate of occupancy, right? So once the building is completely finished, The city has already inspected it. We have the third-party inspector. The bank says, yep, we're good to go to give you your final draw. We achieve certificate of occupancy, and then that allows us as the GP to hire the property manager and put them in place. And then something that also that we're trying to do while the construction is going on, we're having a whole marketing plan in place so we can pre-lease a lot of these units. And then so what we're doing is that we're anticipating on when that construction is going to hit a certificate of occupancy. And if we do really well at that, at timing and predicting the future, we can get pre-leases in place, and then that really significantly helps out that pro forma, as I mentioned earlier. And then ultimately stabilization, right? The property management company really needs to do a good job of marketing and sales and things like that to get folks inside of the units. And the target that we really want to hit as soon as possible. Again, time is money. The sooner we return investor dollars, the higher the IRR is. So that's a great target that we're trying to shoot for. We're very motivated to do that. So we really want to get around 85 to 90% of occupancy. And then when that happens, we can refinance out of the construction debt, which is a more expensive, higher risk loan. And then we'll go into what we call agency debt or Fannie Freddie or a HUD loan, something like that, that's lower risk profile and then lower interest. And then also allows us to start cash flowing and paying down the principal and gaining equity in the project itself. And then when the refinance happens, this typically has like a fork in the road situation for the LPs. Many of them just want to get out and they want to go on to the next project with us or another developer that's timing up another project, or they want to stay in. They say, hey, you guys done a great job. We really want to participate in the long-term cash flow of this one. Let's stay in and then return some of our money back, but we'll keep a portion of it in there and then we'll participate in the cash flow and then gain on this wealth generation with you guys as the general partner.
All right, and that takes us to our final slide that just says thank you for the audience. There are a few final questions. If you've got a few moments, Tyler, I'll go ahead and run through those as I'm getting prepared for that. Let me just flip back to our contact information for the audience so they know how to reach out to you or I over the phone or with an email. Starting off here, just a question I actually had regarding general partners. Do you notice, in your own opinion, a difference with a regionally based general partner versus a nationally based outfit that kind of does stuff on the East Coast, West Coast? Is there any difference in the level of projects or type of projects they typically go for? What would your opinion be on that perspective?
Yeah, that's a great question. So there's pluses and minuses to both. A regional boutique firm, we're going to be more of a boots on the ground, more of a scrappy type of operator. We have to get really creative in our deal structures and things like that. But by being creative with that, that allows our investors to realize greater upside. And then a national firm, they're not going to have as much boots on the ground, but they actually partner with folks with us, like us. I'm actually working on a potential partnership of a national firm currently on a project. So we actually kind of help them fill that void for getting into a new market. But they are established. They do have a very big Rolodex of investors. They also get retail investors from the stock market, things like that. So they have essentially endless resources to do whatever type of project that they like. However, I use the term that they are like the Titanic, and it is very hard for them to turn and maneuver. Whereas, if there's something that happens in the market, they really are affected by those things. And then us as a smaller boutique firm, we can make the correct adjustments to adhere to the current market conditions, which I believe is, I personally have a bias towards, the boutique side of things, but I do see the necessity and what great things the larger firms are doing as well.
Wonderful. Next kind of series of questions, if you will, is kind of about Petra's organizational structure. The first question is, does Petra collect an acquisition fee, and how much? I really implore the person that asked how much to just reach out to you directly and touch base on that. I'm not really asking Tyler to answer that on this time-stamped webinar. And then the second question is, what is your policy on overfunding? Do you guys typically, set up so an investor funds right what you're going to need, or do you have them overfund so that, maybe they get some returns more immediately? How can you kind of address those two items?
Yeah, so for your first question, do we charge an acquisition fee? On development, no, not really, unless it's a land acquisition and we're paying a broker. I am the in-house broker for Kansas City as well. I wear many hats. This is also why I like boutique firms, is so I can do many things. I enjoy doing that. But for syndicated existing assets, there is an acquisition fee, but we tend to lean on the friendlier side of the LP investors, so we can meet that LP IRR and that yield on cost for those investors. So if our acquisition fee or development fee is going to have a gigantic effect on those metrics for our investors, we realize that those things need to be dialed in to maximize the investor return as much as possible. So it really kind of depends on the project, but acquisition fee is mostly on the existing assets acquisitions that we do. And then the next question for the overfunding, that's a little bit more of a question for our investor relations folks that are in our company. So they're the ones working on raising capital and speaking directly with the investors on a day-to-day basis. I'm a little bit more of the deal guy, if you will. And then the quarterback of the project, putting together the team and things like that. I'm not always in the day-to-day with the direct investment itself and how some of those metrics work, but I am involved in that in some capacity. I do know that we do try as hard as we can to be very specific on the amount that we need. So we're not over raising, because as great as that sounds, that we have more investors than what we need, we definitely don't want to overcommit to folks on saying, hey, we need a certain amount of money. Oh, by the way, we have too much over here. Here's your cash back. We definitely don't want to be in that situation at all, in my opinion anyway. I know that some other investors would like that, but I would much rather raise on a more specific basis for the project.
Gotcha. No, that makes sense. And for really both of those questions, again, I do implore the person that asked those to go ahead and reach out to Tyler directly. He can connect you with his investor relations person that can give you more detailed answers on those items. But just kind of staying roughly along the same line, Tyler, and to wrap us up, I just want to talk about kind of the capital stack and payout structure with these types of deals. Because I'm not sure that the average person maybe watching this webinar understands fully that the limited partners actually get paid back first before the general partnership generates or draws any profit out of these types of deals. Can you just briefly speak to that effect? I get that your investor relations person can elaborate way more thoroughly on that when someone reaches out to you guys, but let's just bring it home, just talking a little bit about the capital stack and how everyone in the grand scheme of a syndication investment gets paid and when.
Yeah, that's a great question, a great point to bring up in these. So just so the LP investors know and understand that us as general partners are very motivated to get our investor dollars returned first, because we're not getting any sort of profit or anything like that on the project until we are returning those investor dollars back. Now there is a certain structure that's called a waterfall, to where we have say, hey, we hit a certain metric as far as returns, money returned, and then some sort of profit sharing starts to happen, at a certain basis, and whether that be 50-50, 60-40, 70-30. We tend to lean heavier on the 70-30 side, 70% going to the LP investors and then 30% going to us as a general partner. But that usually doesn't really kick in until we hit stabilization and we refinance out on a development project. So understanding that as well, which is why we try to target higher returns, is because on a development project, the senior debt, the construction lender, is not allowing any sort of dividends to be paid out to LP investors until the refinance happens. So we're also very motivated to get that done as quickly as possible in an effective manner, because we want to return those dollars back as quickly as possible. And this is kind of one of those things that I like to say, the sooner this, the sooner that, right? So the sooner we get this thing done, the sooner we get to pay back everybody, and the investors are paid back first.
Yeah, and one thing I know that you mentioned at the top of the webinar is that a lot of times the general partners invest alongside the limited partners. So, from that perspective, a lot of times these guys have their skin in the game as well from a LP standpoint. So it's just something I wanted to make sure at least we, brought it home and ended the webinar with that, when you're working with a general partner and prospecting a general partner, they have the utmost vested interest in getting you your money back and getting you top dollar back on these types of investments when you make them.
Absolutely. And then Corey, if you don't mind me add one more thing to that too, as far as skin in the game.
Of course.
These projects are very large a lot of times with these developments, upwards to hundreds of millions of dollars for a project. And much of that needs to be guaranteed at some capacity. On a senior debt or on a construction note. And then so that's something that the general partner is doing. We're putting our business up, for scrutiny and things like that to the bank, for them to lend on the project. So if we don't meet those, then we can't even do the project either. So that's something that we don't ask limited partners to do, but we do ourselves. We're definitely putting a lot at stake here by signing on that dotted line for the construction debt.
Awesome. Well, thank you very much for adding that little piece at the end of additional insight. I feel like Tyler's brought us great insight today and expertise from the general partnership side of things. So if anyone is interested in limited partnership investing, please feel free to reach out to Tyler. He can give you more information or put you in touch with his investor relations team that can talk to you about what deals they may have going on. If you have questions about using a self-directed account, you can reach me directly, whether it's talking through what plan types or what type of strategies fit your goals and interests. Feel free to reach out to either of us. We'll be very happy to help you. If you'd like a copy of today's presentation deck, you could message either of us as well, and we'd be happy to share with you PDFs of today's slides. Again, Advanta IRA puts these on typically 2 times a week. So we always bring on different guests, different topics. I'm sure I'll have Tyler on again in the future to talk about a little bit of a nuanced version of this topic, maybe bring some new insight and education to the table. Tyler, thank you so much for doing this with me. I greatly appreciate your time and energy, and I hope the audience got a great deal of expertise from you.
Thanks, Corey. I appreciate you having me, and I enjoyed giving the presentation.